Hello, everybody, and welcome back to Multifamily Talks Live. I'm Krista Hurley, Industry Principal for RealPage. I'm so excited to be back in studio with Carl Whitaker, our Chief Economist, for the mid-year market check-in. Multifamily Talks Live is a live video series you can expect monthly, talking about all things multifamily here on LinkedIn. Think live, candid conversations in more bite-sized format. And if you can't tune in, no worries. You can watch or listen to the replay using the link below or wherever you listen to your podcasts. And make sure to follow us on LinkedIn so you don't miss out on any new conversations. And please don't forget to ask us any questions in the comments. We'll be sure to follow those up. Now, Carl, to kick us off, there's been so much anticipation around how 2025 would shape up, right? Especially after everything we saw at the tail end of 2024. Operators and investors alike were bracing for both headwinds and opportunities. So from your vantage point, how would you characterize multifamily performance so far in 2025? And furthermore, are we outperforming, underperforming, or holding steady compared to the expectations we had 6 months ago?
Yeah, thanks for the question, Kristen, and really glad to be here. It's good to join you in studio for a different format than our typical long version webcasts. But I love the question, and I really think that if you're looking at 2025 thus far year to date, it comes down to a matter of perspective. You know, if you thought 2025 going into the year was going to be rock solid, then you've probably been a little bit disappointed. But if you thought 2025 would be a repeat of 2024, where this time last year we were talking about how much longer do we have to go through the muck and the mire, then you probably would have been encouraged to see that 2025 is shaped up a little bit better. So if you zoom out and look at what's happening that's a pro or a tailwind that you mentioned in the industry and the economy, it appears that all that noise that we're seeing in the economy, all the geopolitical tension that we hear about lately, what's happening with inflation and tariffs, that does still matter, but it hasn't derailed demand. And that's where it's important to make that distinction for the multifamily sector in particular. We talk about supply. That has been the topic du jour for now the past 2 or 3 years. We're finally at peak supply, so we're still not quite there in terms of relief, but there is that light at the end of the tunnel. Now, on the headwind side, and this is maybe one of the more surprising things that I think we've seen both in the data and in talking to folks. You know, you and I were a bit out at NAA a couple weeks ago, and I think we heard some groups say this, that year-to-date leasing activity maybe hasn't shaped up to be quite as strong as what we would have thought, and really even more so in the past, I would say 2 months, where that typical summer lift, you haven't quite seen that materialize. Some groups think maybe this is a little bit more to do with some of the economic noise. Some people think this is maybe more to do with some continued disruption from the pandemic, and the summer maybe isn't as important as it used to be in terms of leasing activity. But regardless, some of that expectation that you mentioned hasn't quite shaped up to fit what some folks had expected at the beginning of the year. So if I just had to use a pure analogy, I like to think in terms of analogies and aphorisms and parables. If I had to use an analogy here, 2025 is, think of it in terms of like a highly anticipated movie release. Audiences or operators in this analogy, they haven't been on the edge of their seats. It hasn't been that 2025 has been your next Oscar-winning film, but it hasn't been a case where people have felt disappointed. They haven't felt like, the movie was a waste of time. It's been somewhere in between there. Now, that said, you're a lot closer to the day-to-day interactions with folks than I am. I'm looking at the data, which is always, gravy from an academic perspective, but you're actually out there talking to folks on the front lines. I guess, what did I share that counters what you've seen or confirms maybe?
Yeah, so that's funny, and I love your analogies always. I actually just spoke to an operator just yesterday who shared that while they are fully leased for June and July, they're seeing a very sharp drop-off in leads for August. So yeah, I'd say that lines up with the slower leasing momentum we're seeing across the board. So let's zero in on the geography for a moment. We often talk about the market as a whole, but as we know, real estate is hyper-local. What are the standout regions or metros showing unexpected strength or weaknesses this year? And any surprises in rent growth, occupancy, or new supply absorption that may have caught your attention?
Yeah, I'm really glad that you mentioned the hyper-local commentary there, and I'll just take a step back here. It drives me nuts whenever I post on LinkedIn and we're posting these national trends and somebody says, well, yeah, real estate is local. What my market isn't seeing this. And I always kind of have to remind myself, like, okay, people get a little bit myopic. They get a little bit focused on a couple things. I know that real estate is local. It's hard to fit some of these things in 3,000 characters on a LinkedIn post. Anyway, I digress. I think we're starting to see in some of the more localized performance, that is, some divergence in terms of those sub-regional trends. And what I mean by that is that if you look at the West Coast, for example, rent growth is starting to tick back up a little bit. And I think it's more so due to the fact that you just don't have a lot of new supply out there. Maybe even more important than that, though, the fact that occupancy in the West Coast is getting back to quote unquote normal levels. That's really the driver behind rent growth, especially on the West Coast, which is just sensitive to occupancy changes. Now, this is true, especially in some of those markets that are now seeing some improved job growth from this big AI renaissance that we're seeing.
Yes.
Think of those jobs that were getting laid off 3 years ago in the San Francisco Bay Area. Well, maybe those aren't being replaced one to one, but they're kind of being retooled with, maybe it's a software, what was previously a software engineering job is now some sort of rebranded AI position, and it's like AI developer or something along those lines. So some of those markets are starting to recapture some job growth, and that's helping demand. That's in turn spurring some rent growth. Now, again, this is where the sub-regional theme and that divergence comes into play. Places like Los Angeles, places like San Diego. I know Denver's not on the West Coast, but West Coast-esque in a lot of ways in terms of operational behavior. Those markets are seeing some more demand headwinds still. So it's not necessarily that those that the West Coast on aggregate, I would say, is moving at a congruent pace. Is probably the best way to put that. Same in the South. You look at the Sun Belt. You kind of have this tale of two cities. You have the small South region markets. You're based in Greenville, South Carolina.
Yep.
So what's happening there is different than, say, what's happening in Charlotte or Atlanta, some of the bigger regional metros. What you're really seeing, at least in my view, is that especially when you start getting into the smallest of the small metros, there are a lot of college towns. And it's interesting, these college towns, you turn on the TV on the weekends and you turn on the TV in college football season, and it's the teams you're seeing at prime time on Saturday. It's College Station, home of Texas A&M, Fayetteville, Arkansas, home of the University of Arkansas, of course. All of those places are actually seeing pretty strong performance today. And I think a lot of that is because you have a lot of stability of demand provided by college students, the jobs needed to support those areas, but not a lot of supply either. You just don't see a lot of new development in, say, Lexington, Kentucky, for example. Now, and I'm probably not doing a good job of being brief here, but within the South, again, going back to this idea of the split, you still have the supply burdened areas, and I'm sure many of y'all are familiar with these markets. It's your Austins of the world, it's your Phoenixes of the world, the San Antonios out there, where demand is strong, but you're just simply delivering more than you can absorb. And with that, rents are backtracking. The pace at which they're backtracking is starting to slow a little bit, but still down year over year. This is also true, and especially even more so true in these little Zoom towns. You may think back to 2020 and 2021, where you were talking about places like Myrtle Beach and Asheville, the places where people were unplugging and then plugging back in to work remotely. Well, a lot of supply came online to satiate that short-term demand, and some of that demand is permanent, but not all of it was permanent. And now you've got this weird kind of hiccup and lag between what's delivering, what's being absorbed, who's permanent, who's temporary. Places like Naples and Cape Coral in Southwest Florida. There's a lot of these smaller towns that would fit that profile. So anyway, long story short, some incongruent supply and demand trends in some parts of the South, but overall, we still think that demand is in pretty good shape. And then finally, you have the Midwest and the Northeast, and this part I can keep a little bit shorter. Slow and steady wins the race. We've used the analogy before of the tortoise and the hare. The Midwest and the Northeast is just kind of your proverbial tortoise. It doesn't win races necessarily all that often, but when the hare needs to catch up and catch his breath, that's when the tortoise starts to sneak ahead. And then this analogy again, the tortoise being the Midwest and the Northeast, something like 80% or 8 out of the top 10 markets today for rent growth are in that region.
Wow.
And again, it just boils down to, you don't have a lot of supply. You've got a slow trickle of demand. Now, just interesting anecdote. I was in New York City last week, and was there along the New York City, the Manhattan, Jersey City waterfront area. And we talk about the Northeast not getting a lot of new supply. I posted about this on LinkedIn earlier, as a matter of fact. If there is one counter to that narrative, it's the Jersey City and parts of New York City market that actually are delivering a lot of new supply. And I think it's really neat to see supply is finally starting to deliver in an area that just critically needs it. There's just not enough housing in New York City, and there still won't be after all this supply delivers. But again, it's moving in the right direction now. Um, One more thing that I did want to bring up in terms of some of these regional trends, and something that if you had a second follow-up question to this of what are you watching through the back half of this year, we aren't seeing the extreme outliers that we saw the same time back in 2020 and 2021. In other words, some markets in 2020 and 2021 were backtracking 10%. Some markets were growing 15 to 20%. You saw that those started to converge around more of an average level. Now you're not seeing as much of that happening, but you are starting to see some of the laggards remain super sluggish. And I talked about Austin earlier. We talked about some of these areas that just have so much supply that they can't absorb it all at once. On the counter, you talk about the quote unquote outperforming areas. Those are areas that are just getting 5% growth today. And it's not necessarily the who's who of the apartment sector. It's, Rochester, New York and Syracuse, New York. The one exception there, San Francisco, we talked a little bit about that earlier. San Francisco started something like 80 new multifamily units in 2024 throughout the entire metro area. And I don't have the exact numbers. San Francisco's home to what? 2.5, 3 million residents.
Mm-hmm.
Don't quote me on that. But you're just not seeing a lot of supply delivering there. Demand is catching back up. I think rents are going to start to adjust pretty sharply as a result of that. And again, getting into some of those laggards, I won't go through all the markets in depth, but a handful of markets where rents are falling by 6%. Again, that's going to be your Austins, it's going to be your Asheville, North Carolinas. But in that, it is kind of an interesting case study in how supply actually does help offer some or alleviate some affordability challenges.
Yeah, and there's one thing that you mentioned there in terms of just the different markets need different attention. And it just had my marketing brain triggered of like making sure that you have the right amount of marketing in that area to even attract others from different areas, right? To really use that ad spend the right way to get that supply, or excuse me, that demand back into the oversupply.
And that's something we see too, is, or at least that I hear anecdotally, is that a lot of folks are like, yeah, we see the traffic, but it's just harder to convert those leads because, it's so competitive when the property across from you is offering 2 months free. And again, it's a good example of how supply actually is good for the renter.
Yeah.
But it's a very competitive market. So the demand is there. It's just hard to capture.
Yes, agreed. So that does bring us to a topic that seems to dominate every conversation that I have lately, which, as we just talked about, is the oversupply or supply. The industry continues to watch these new deliverables in wonder. Will they absorb it all, and where might we see other pressure points? So what's the latest with new supply pipelines, and how are markets handling this influx of new deliveries?
Yeah, so I hope this saying doesn't come off as too grim, but I do like this particular analogy again, because I think it's the best way to summarize the market from the supply side today. And that saying is, the only way to eat an elephant is one bite at a time. That's really what it feels like trying to work through all this supply. Yes, it is being absorbed. It's just taking longer. It's just so much going through in such a short period. It's going to take some time to work through all this. Now, what we're seeing is that, again, that demand is there. It's just taking a little bit longer to capture. The way to capture that we're seeing, a lot of operators are either offering rent cuts or concessions or, some sort of incentive to get somebody in the door. And, just like you said, creatively using those marketing dollars.
Yeah.
Now, in 2024, for example, we saw what was an interesting trend in my view, which was actually the fewest number of lease signers per household. That's kind of a mouthful. So basically what it's saying is that the average household size was the smallest we've seen since 2017, 2018, i.e., if you and I were living together and there's a property across the street that is offering 1 month free, well, inherently, you're kind of incentivized to move out in some ways
My own place.
and have your own place. Exactly. And it's not to say that you and I had a bad relationship when we were living in that unit. It's just it makes sense.
Free.
Yeah, exactly. It's just, it makes sense to move. So, concessions are really kind of the nexus of that. And I think concessions are going to be something that we continue to hear throughout the end of the year. It's another one of the things that I would put an asterisk to say, let's keep our eyes on this. Concessions are great for the resident when they move in, but when the concession goes away, there can often be some sticker shock, because just simple math says that a 1 month free concession is equal to an 8% rent increase just by nature of that concession burning off. And for those of y'all that maybe aren't in the numbers as heavy, basically the math here is 1 month divided by 12 months in a year, 1 divided by 12 is 8%. So that's kind of the math behind that.
Got it.
But really what again it's saying is, or where this is potentially heading, I should say, is that if concessions remain as common as they are, good for the renter today, but we may start to see some turnover happening because of that sticker shock again. It's not happening yet. Retention has been strong, and it's been one of the areas that, just candidly speaking, I've been wrong in the market over the past 2 years. I've been surprised at how strong retention has been. But if concessions continue at their current pace, we could see some pain points from an operator perspective with more turnover effectively being incentivized. And then you get to the point, some point in the future when all these lease ups are absorbed. Well, that I think is where you'll start to see retention increase even further because there's fewer places to go move around and move into. So I guess if I had to summarize, and again, not my strong suit is summarizing, but if I had to summarize, I think the high supply markets, if I'm operating in those markets, I would watch for the potential for retention to decline or the potential for turnover to increase. I would watch for the potential of concessions to start to really kind of put the clamps down on some of your operational strategy. And also the turnover costs, or, when turnover happens, it just inherently means you have to spend more marketing. You have to go out to more ILSs. You have to focus on physically renovating that unit. Well, that costs money, and now it costs more money because you don't know how much the input costs are going to be because of inflation. Oh, and by the way, what sat vacant for 30 days a year ago is now going to sit vacant for 45 days. So there's a lot of soft costs that come into here. And again, this is where I'm curious that, you may have more interface with folks that actually deal with this day to day. But to me, it's these small components that on aggregate could add up to be pretty significant.
Well, and retention normally isn't my expertise. I'm usually in the front part of that, which is, driving leads with marketing and then capturing that with your CRM and converting it. But when you mentioned, you being wrong with retention, not to call that out again, but it was a shock to me too. Even hearing that 8% increase, it does make me think like, oh, I would be sticker shocked.
Right.
But operators and owners are looking at more of how can we offset that by incentivizing them to stay with behaviors through a portal or an app and making it a little bit more sticky. So, that just triggered my mind on some things that RealPage is doing with that to really help those owner operators to keep their people.
It's a good example of where when a challenge arises, so does an opportunity,
Yes,
and
yes,
like
exactly.
looking at it as an opportunity in some ways, I think is a healthy way to approach it.
Yeah, for sure. So let's zoom out for a moment to the broader economic picture. We've had a volatile environment with interest rates, job growth trends, and inflation all moving in different directions. So how are those macroeconomic factors influencing the multifamily outlook as we sit here mid-year? And have any of these shifted significantly since we talked in January?
Yeah, that's just a good question. And I think the short-ish of it would be there has been some things that have changed. And just a quick note that my colleague and I, Arben Skiviani, hosted a webcast earlier this month in June where we at least tried to capture in a somewhat succinct manner some of the economic shifts that have happened. So if you have, 45 free minutes, I encourage you all to go check out the webcast there. realpage.com/webcast is where we have that repository. Shout out to our amazing studio team who's able to facilitate that in this discussion we're having today. But if I had to go down and say, okay, here's for any football fans on today's discussion, my Chris Berman fastest 2 minutes style of what's happening with the economy. Volatility and uncertainty are like the two terms that we continue to hear. And I think those are valid terms that we hear in today's environment. Those are the two things that are spooking investors to the most significant degree. Now, when you look at the underlying economic data, some of the more nerdy stuff, job growth, CPI, or inflation, those metrics actually look relatively okay considering all the background noise. It's maybe not rock solid, but the market's been in worse shape before and fared okay. So we're actually seeing that some of those underlying fundamentals are in decent shape. Now, interest rate cuts have kind of been that proverbial thorn in everybody's side. We're still not seeing those rate cuts materialize yet. The Fed has signaled that they are, the appetite is there to issue some cuts later this year. So maybe that inspires a little investor confidence. But we don't know until that actually happens. I tend to be of the school of thought that we would see 2 cuts this year. I still think we see that, but I think they're going to be at the very, very final few meetings that the Fed has. Now, if there's one big shift since January, then I would say that it's just, the lack in response, the slack, I should say, in response time and how long it's taken those interest rates to be cut. Now, the other thing that's changed in the past few months, and I think this is one that's really worth interesting. I was literally reading an article on this earlier, but right before we got in here. Debt delinquency started to climb a little bit again. Now, it's not significant. This is where that matter of perspective matters, because relative to where we were the past 2 years, debt delinquencies are up. Relative to where we were 2019, debt delinquencies are lower than they were back then. So it's really that matter of perspective. Anyway, when you start breaking out the components of where that debt delinquency is largely stemming from, it's from the returning of student debt and student loan repayments. So there is potential that we could see wages garnished in the event of non-payment. So we could see that debt delinquency increase a little bit further. It's not necessarily yet to a point of widespread concern, but these things don't happen overnight. That's something that we are going to watch closely, and we encourage you all to watch as well. The biggest thing I would look at the second half of this year, though, is that we just don't know. We still have such a clouded perspective on what can happen. There's been a lot of geopolitical tension here lately. There's been a lot of ups and downs with the stock market over the past couple of quarters and past couple of months. So I still think that shaken consumer sentiment, that shaken investor sentiment, and then finally just all the uncertainty are the two things that will likely continue to drag on the economy for the next couple of months.
Yeah, unfortunately, uncertainty is a scary place to be in for sure. But let's talk to the people who keep our industry going, our renters. Are we seeing any notable renter behavior trends in 2025? I know that this is sort of my expertise, but things like migration patterns or unit preferences, price sensitivity, anything that's shifting how operators need to think about demand.
Yeah, no, I'm glad that you bring this up, because I am going to turn the question back over to you, because I'm curious to get your perspective. As you said, it is more your wheelhouse, but I like that you touch on the migration comment, because we're actually in the middle of updating our forecasts right now. This is, again, maybe getting a little bit nerdy, but we're in the middle of updating our forecasts right now. And I've actually been noticing that a lot of our forecast models are shifting preference, or have shifted preference over the past couple of years, to really begin emphasizing more of the impact of migration. And I think that that's just a realistic reflection of the world the past couple of months or past couple of years, is that people have been moving in a more frequent pace. Now that's starting to slow down, but there was a big reshuffling of the population in the early 2020s. Now, many of y'all probably saw or have seen these articles like, the death rattle of Austin and its tech sector, where all these people that moved from San Francisco and California are moving back to San Francisco after spending 2 summers in Austin because it's too hot. I'm sure that's happening to some degree, but it's not necessarily happening in the data on a massive scale. All these people that moved down to Florida, from New York, and got all these great tax breaks that are, well, now I have to go back to New York. Again, those things are happening. They're just not happening as big as what the headlines might suggest. That in the data backs this up. The Sun Belt, for example, Austin, for example, you're still getting people moving in there. It's just not getting as many people as it was 2 to 3 years ago. Mm-hmm. The difference is now you're delivering more supply, i.e. why rents are adjusting. But that's a different talking point for later. So I think we're really just entering a more normalized migration pattern than what we saw the past couple of years. We got used to something that was abnormal. We should probably get used to something that's more normal. And I would look at 2018, 2019 as a healthy benchmark, if you will. Now, I kind of touched on this. One thing I do think that's worth watching in terms of its impact on maybe more of a micro level for renter preferences is return to office mandates. Yeah. Just think, you have to be, the past couple of years, I live an hour and a half from the office here, and I'm probably in once or twice a week. If we were in office 5 days a week, that math just simply doesn't work.
Right.
Well, there's a lot of people that are in a similar boat where they've moved further out if they're going into the office once or twice a week. There's a lot of people that have moved out of state if they're not required to be in office at all. So I do think that return to office mandates could have a tangible impact on what we see in the big urban centers, the New Yorks, the Washington, D.C.s. Washington, D.C. is another interesting potential market with what's happening with some of the government shake up there. So I do think that we'll just start to see more of a I say this word too often, but we're going to see more of a nuanced trend within these local urban centers. And I think return to office mandates could be a big catalyst behind that in certain geographies. But again, I had to turn it over to you because that's a little bit more of like the econ 101 stuff. What are you seeing from, or I guess, what are you seeing and hearing from folks that you interface with?
Yeah, I mean, but that does matter. The 2020s, early 2020s, right after COVID, everybody just wanted to get out,
Yep.
right? So like try a new city and stuff like that. So getting back to your roots, but also those mandates are becoming very real. But in chats with my clients this year, they're seeing renters prioritize flexibility and value that more than ever. So many people are opting for smaller units in prime locations or choosing properties with strong amenity packages that enhance daily life, like co-working spaces or even smart home tech. And price sensitivity remains high, with more renters shopping across asset classes and geographies to find their best deal. And this shift is pushing operators to rethink not just pricing, but also how they position and package their offerings to meet evolving expectations. But before we look ahead, I'd love to hear from the audience. So what is your biggest concern heading into the back half of 2025? I know that Carl has commented on it, but some responses could be like supply outpacing demand, or regional economic slowdowns, maybe rent growth stagnating, or even changing renter expectations. So please take a moment, submit your responses. We'd love to hear them, and we'll circle back in just a bit.
Yeah, real quick too, Krista, on that. Something that I think is interesting is generational preferences and how they shift. You and I were talking about how we're firmly in the millennial generation.
Yes.
Well, the Gen Z has different preferences. So anyway, I didn't want to derail you there, but I think that's a total another topic we could cover.
It is. Topic for another day, maybe. But as we wait for those poll results to come in, so please, and also ask any questions. We'd love to be able to answer them for you guys. But let's talk strategy. What should operators be watching closely in the second half of 2025? Is there a specific trend, a data point, or potential risk that you think deserves extra attention right now?
Well, I'm glad you touch on this too, because it offers that more practitioner perspective. But I think leasing activity is a really big one to watch, and it all starts with leasing. The industry doesn't run without leasing. Like, that is the core fundamental of the sector here. We talked a little bit about how it's been a little bit slower than what some folks maybe had hoped to see. I think some groups probably came in with a realistic expectation and have been a little bit less disappointed. But at the end of the day, we just haven't seen quite as much we've seen a pretty healthy level of traffic. We just haven't seen the ability to convert as many of those leads into realized leases as I think some groups maybe had hoped, because everybody is so hyper-focused on the fact that we've quote-unquote hit peak supply.
Yes.
Again, these things don't happen overnight. These things take some time to churn through. Now, there is the question too, and maybe you can chime in on this, of with the new leasing activity being a little bit maybe weaker than we thought, is some of that due to operator shift and focusing on retention? I think there's some truth in that, maybe, where an operator, I say this all the time, a bird in the hand is worth two in the bush. I've got a renter in the unit today. They've been a great renter. We want to create a sense of community. That's another kind of like qualitative component we can add in. Rather than risk this renter leaving, I'm happy to just have them stay, because I don't know how long it's going to take to backfill that unit.
Yeah.
I hear that. Do you hear?
Yeah. And the turnover, and I mean, we're 40% down on maintenance staff, and they're the ones that do these turns. So that's a big point too, in terms of getting those leads in seats.
That's a fascinating data point too, just that turnover, because we talk about renter turnover all the time, but we don't talk about staff turnover.
Right.
Well, that's hugely important for really all industries, but especially the multifamily sector, where you just, it just takes a different level of understanding and working with these properties and working with renters and working with 300 different units. That's 300 different households in one property that you could be working with on quite literally a week-to-week basis. But yeah, so I think those are the two things. I think the other thing that I would look at too, if I get a little bit more detailed here, would be separating lease ups out from the rest of the market and just seeing how performance among lease ups is trending. If lease ups are absorbing a little bit quicker, then that's a good thing. That means that demand is strong. If lease ups are taking a little bit longer to absorb, that's not necessarily a bad thing. But if they take longer to reach stabilization, that could be something that affects property level operations. And I think this is where you and I get brought into a lot of conversations about this time of year when budget season starts to kick off, and we start to get pulled into those August and September discussions of like, tell us what we need to be focused on for the next 6 months. So if I had to say what I'd be most focused on though, here in the near term, it would be again just how many of those leads are being converted into actual realized leases and being done so without risking without increasing the risk of I'm just trying to get a renter in here.
Right.
There's another component.
There is another component, a lot of fraud right now, and making sure you're not just pushing any lead through. And you really do want those good residents. Obviously that makes their day to day even better.
Yep. Fosters community.
Yes, it does. So with that, let's tie it to demand. So what does the data suggest about the strength of demand heading into Q3 and Q4? And are there signs that we should be optimistic or cautious?
Yeah, I was using a cheat sheet here a few minutes ago, and I saw that one of our one of the groups we work with quite a bit in the industry had just posted something that said that first quarter 2025 was some of the strongest demand we've ever seen, and this is where it's such an interesting example of where that site level experience doesn't necessarily match the economic headlines of, well, if I've seen economic demand has been super strong, then why am I not necessarily seeing that at the property level? And I think you and I have hopefully covered why that is thus far, so we won't wax poetic on that for too long. But to me, it just seems like a lot of the demand out there, again, I'm going to use an analogy. If you think of demand as a tablespoon of butter, if you have a tablespoon of butter and you apply that to just a typical piece of toast, you can cover most of the toast with that butter. Take that same tablespoon of butter, in this analogy, the butter being demand, if you apply that over a 12-inch long hoagie, the butter doesn't go as far, and that's kind of what's happening, I think, is that the demand, the aggregate number is out there, but it's not being equally applied and spread out across all geographies and all properties and even all unit types. I'm so glad you mentioned unit types there, because I don't have this data in front of me, but I would imagine in some markets it's harder to fill a 3-bedroom than it is to fill the 450 square foot studio. Just it totally depends on that local renter demographic, the needs of that local market, so on and so forth. So, I just think that, and thankfully there's people that are smarter out there than me that get to figure this out. But being able to figure out how to capture that demand, this is where folks such as yourself can really, support and facilitate some of those good conversations and how to capture that demand that is again out there, just harder to capture. Another thing I think that I'm focused on, and something that maybe I would describe as cautiously optimistic for now, is the fact that we're starting to see some alleviation on expense pressures. Mm-hmm. And I think this is a big one, because this is kind of, like you said earlier, something we've talked about ad nauseum at this point, of expenses are going in. And even in our personal lives, it's kind of been a bummer to go to the grocery store for the past 4 years. And you're like, well, how much are eggs going to be this grocery store trip? You think about budgets that are set one time in August or September, and you're like, I think that turnover costs are going to go up 10% over the next year. Yeah. Well, you look up and you're like, oh my gosh, turnover costs went up 40%. Like, there's no way we could have assessed that accurately.
Right.
Now we're starting to see a little bit more normalcy return. And I'm glad that we have a graphic here for those of y'all that are joining the video version of today's discussion. I'll try to capture it for those of y'all that are doing audio only later. But it shows how expense changes, or growth in expenses is changing over time, i.e., we're finally starting to see most categories of operating expenses decline in terms of how fast they're growing. Now, this doesn't mean that things are becoming cheaper, but it's that sticker shock that's wearing off of your insurance costs that went up 40% and some 50% in some markets over the past year are now going up 8 to 10%. And really, it's all categories that are showing here that have a similar trend, other than utilities, other than payroll, which is two a little bit more sticky components. But for those of y'all that are again listening to the audio only, this graph shows you that insurance costs, yes, they're going up, but they're going up at their slowest pace in a couple years. Turnover costs in some markets are actually going down, so it's not as expensive as it was last year. Marketing costs, they're going up a little bit, but they're not going as much as they were this time last year, because this time last year you were advertising 6% or 7% vacancy. Now you're advertising 5% vacancy. Well, a percentage point doesn't sound like much, but when you apply that on a 20,000 unit portfolio, that makes a big difference. And this is where the margins are super, super interesting to dive into and talk about. This is why, we get pulled into these conversations.
Yeah.
So again, most expense categories are cooling, I would say. Maybe not, maybe cooling is the best word to say here. Now, last thing that I'll mention is that when we start talking a little bit more about risks, is that we don't know if all of these categories will continue to remain a little bit more manageable through the end of the year with things like tariffs. If all the carpet that you have in your warehouse that you've burned through, now that you have to order, I don't know how many cubic square feet of carpet from a supplier, maybe that carpet is now 15% higher than it was last year because it came in from overseas, and the storage costs. So these are some things that may change to the end of the year. The good news is that OpEx is easing up. The bad news is that there are some uncertainty and some unknowns here. Quick shout out to our team, our economists on staff who actually did a webcast yesterday focused on this too, where they dive into the tariffs and expenses and how that kind of coalesces together. So anyway, thoughts there or anything?
I'll have to listen to that because that, if you guys couldn't hear this in the audio or seen this in the video, Carl actually exhaled when he talked about how insurance costs are going out. Like, it was actually what every operator that I talked to about insurance costs, they would have felt that too if you heard that it's going down. So that was a great audible. But I'm going to just ask, if you had to sum up 2025 multifamily market in one word so far, what would it be and why?
This is your hardest question because if there's one thing I'm not good at, it's summarizing or being succinct. If I had to say one word, I think I would probably say resilient.
Okay. Resilient. That's a good one. Yeah. Well, awesome. I just want to thank you, Carl, so much. You gave me so many good insights and tidbits that I definitely can bring back to my operator friends. And even with the call outs of the other additional webcasts or what Arvin's doing with the RealPage Economy Express. Yes, I got it. Well, thank you again, Carl. And thank you to everyone who joined us today on Multifamily Talks Live. If you asked a question that we didn't get to, please continue the conversation with us on LinkedIn or drop us a note. And remember, the replay will be available immediately, so feel free to share it with your teams. We're excited to continue this series and offer up valuable conversations and topics that you can expect monthly. So we'll see you next month.